Hey everybody, Preston Brent here with the Trader User Group Weekly Roundup. This is for the trading week ending October 3rd, 2014. What I've got on the screen here is the cash index for the S&P 500, the SPX. I wanted to just kind of show you a couple things, and I still believe that we are in an uptrend. And we're doing what we've been doing for quite some time. And until we break a couple of key parameters here, then I'm going to stick to an uptrend. And near term, of course, we've been bearish, and we've played bearish trades. But longer term, we still haven't violated any of the key levels that we need to violate to give us a larger pullback. If you look at the screen here, I've got us on a daily chart. And you can see this goes back to the summer of last year. You can see the trend line that we're holding here for the S&P or the SPX. There has not been one close below the lower part of this trend line yet. We've had intraday moves below, but we have not closed the day at the end of the day below the lower trend line. You can see the 200 EMA, which is this yellow line, is just working perfectly up in the trajectory here. The trajectory of this trend line is running like that. So this is kind of where we're sitting right here. And the Dow, of course, has done much better than some of the other indices has. Let's get the indicators back on here again. But the Dow has done, the best performer has been the NASDAQ. That's done very well. But the Dow has also done very well, primarily this year because the large cap is where money is flowing. And I think money is going to continue to flow in the large cap through the end of the fourth quarter. I don't see that relationship between large cap and small cap changing. And just as a reminder, I did this in last week's, but I'm going to do it again. Let me just get the screen back up here for you. What I have here is, if we take a look at the year, starting out in January, and then I'll just show you just kind of where we are. Inside this box is where we've been the entire year. We entered the year right here. We pulled back a little bit going into February, but we quickly regained it going into March. And we passed, we were actually year-to-date positive going back into March. And now this is where we're sitting right here. So we are, you know, if I connect the dots, you can tell that the trajectory is up. It's not as steep as the original, but it is still up. And we're still well above key levels. The first one in my mind is this level right here, which is the upsloping trend line. The second one would be this key pivot sitting right there. Call it 1897, 1900 area. So that would be another key pivot for us. Now, if we look at this and we blow it up just a little bit, just so that you can see a little bit better on your screen, I'll just get it into view here for you. You can see, as I said before, we've had intraday moves below the trend line, but we've never closed below it. Now, I want to see us on the cash index take out that level right there, 1985.59. This is on the cash index now, not the futures, but the SPX. I want to see us take out this line to erase the downward stroke that we've got here and get us back up more towards challenging the highs here of 2019-26. That's what I want to see. The other thing I'd like to see is the RSI get above the 50 line on the halfway point. I'd like to see the RSI over 50. If we see that, then we're going to see continued strength, and we'll continue on the SPX to grind higher. Here's the 50 EMA. It's turned pretty much flat right now. We need to take that out. It's sitting at 1975 roughly. That's an exponential moving average. So that's kind of where we're sitting right now, folks. What do we need to watch for? A rejection at that level around 1975, and then a push back down early next week down to the 1943 area, all the way down to 1940, and then we come down and we challenge this area right here. Okay, that is what we want to watch out for. And you can see 1926.03 on the cash index. We want to watch that very closely. We do not want to violate that. If we do, we're going to break 1900 and we're going lower. Okay, that's pretty much the way I would see it right now. We would go lower. So this is the levels that we want to watch. Our group, what I would call this would be our S1 level of support. That's our first level at 1941. And then our S2 level here would be 1926. But if we can penetrate the 50 EMA, then I think we'll challenge this R1 level, our first level of resistance here at 1985. All right, so notice we got a fairly wide range. You could probably thank volatility for that. We've had a number of big candles every day. We've had some big candles most of this week, in fact. Now, a very bullish candle was this candle right here. I'll blow it up so you can see a little bit more. This candle right here was a very bullish candle because, you know, we opened up the day and then it just looked like it was going to free fall. I mean, all the way down like that because we opened up at that level right there. But then we came right back up and closed almost break even for the day. So buyers came in and pushed it back up inside that channel. So that tells me that there are buyers active and they're hunting for good stocks. Most of them, though, are large cap stocks. They are not small cap stocks, which is why the Russell is just really been damaged dramatically. If I show you the Russell, you can see here with the Russell. Let me get the Russell futures on here because I got a lot of marks on that chart here. See if I can get the screen up here for. Okay, we got the Russell up here. Here's the Russell futures. You can see all of these regression channels that I've got up here. I just wanted to show you just how crazy this year has been for the Russell. Each one of these regression channels is the direction the rut's gone for the entire year. Again, just like the S&P 500, if I were to mark out the year for you and show you just exactly where we entered the year and where we left it, it would look like this right here. Okay. And you can see that we came into the year right there. And this is where we sit right now. And we've had a number of tests in this area right here. I mean, it's a zone. It's not a particular price level. You can see right in that area there. We dipped down briefly, but we closed back inside the zone. And we are sitting ever so perilously down at that level right there. And you can see where we entered the year right there. That is our trajectory. It is not good. The rut. Small cap stocks. You can see here we've come up and we've tested. It looks like someone is just drawing the letter M several times. Now I've heard some people say, hey, it's a head and shoulders, but it's really not. It's not a head and shoulders pattern. But nonetheless, the measure and objective, should we break this here, is going to be dramatic. It's going to be a huge pullback. Next level down, if we break that level, is going to be 1034.88. I think it'll be a very quick one, and then we're going to come down to 1009, down to the 1000 level. If we break it, I'm not saying we will, but if we do. If we do catch a bounce in the markets next week and buyers start to step in, I think you'll see the rut come up, but not at the same trajectories you're going to see the Dow and NASDAQ. So if I was going to go long next week in the futures market, I would probably pick either NASDAQ or probably the Dow as a safer bet. Although the rut, I just don't see a lot of big money coming into the small cap. You can see right here, the red is the 50 EMA and the yellow is the 200. We're very close to having what's known as a death cross, where both the 50 and the 200 EMA cross, with the 50 crossing the 200 to the downside. That is a lot of weakness. And unless this thing resolves itself and we get a little bit more money flowing into the small and mid cap, I think the large cap's going to eventually give it up. That's why I'm still really watching this. Now, I did indicate that on the SPX, I said we're still in this bullish uptrend. Here's the SPX again. What would change my mind? Well, we got to obviously get out of this channel. That would be the first thing. If we get outside of this channel and we take out 1926 and we actually close out outside the channel, you'll see the 200 EMA in yellow, sitting right at that 1897 area, just slightly south of 1900. We get down in that area there, then all bets are off. Then that means we are now looking at possibly going much, much lower, all the way down to that key pivot there, which is sitting right just north of 1800, probably 1815, 1810 area. So we could get very ugly very quick. But as of now, everything is holding. We're going to treat it that way. Now, I've had our members, and I myself too, we're taking smaller positions and we take profits very fast. You want to do that. Now, I want to show you the Dow here. And let me just go out for a weekly chart just to show you something interesting. And if you take a look at the weekly Dow, you can see, and this goes back all the way to 2000, the year 2000. So it's a very valid trend line. This is the peak in the year 2000. This is a weekly chart. This is the peak before we had the big crash in 2007. And then you can see this is where we are right now in the upper right-hand corner of the screen. And you can see this upsloping trend line has served as support for us up in this area here. So let's zoom in, or let's roll over here just so I can show you what I'm talking about. You can see right here that this has, yes, in fact, been a good support area. Each bar is 1 week. We sat there for almost a month. And you could tell here we sat there for almost a month trying to break out. We did break out for 1 month, and then we quickly came back down, tested a longer-term moving average, and then we came back up again. We broke out, and we came down and tested it again. And we have not been able to sustain any more downward movement. These are weekly bars, so we've only closed maybe 2 weeks below this channel, and then this is where we sit. So I do believe that this could be a key support area for us, which puts the Dow right around 16,411, 16,400 area. Now, the other thing I'm going to show you on the weekly chart is going all the way back to about right here. All right, that's in January of last year, going back to 2012 almost. You can see that the RSI on the weekly chart has not gone below 50. Basically, that means that every closing bar on average, it's a 14-bar look back for the RSI. Every bar, as price actions close in the upper 50 percentile of the trading range for the week. But looking at this, it's very clear we're making higher highs, right? I mean, that's very clear. But look at the RSI. We're going down like that. So we're getting ready to have some action here. That's why even though we're still in an uptrend, I've got my finger on the trigger. In case we break this and we go down, folks, it's going to be a long ride. The next solid support point is around 14.8 for the Dow. Okay? And we're sitting now at a little over 17,000. So that's a, 2,800 point drop in the Dow. Now, again, this is a weekly chart. It could take a month or two, a couple of months to get there. But it won't take very long. And that's what I'm watching here. So these, and then one other final one is the NASDAQ. If we take a look at the NASDAQ, this is the strongest one. Again, this is a weekly chart of NASDAQ. It's the strongest chart that we've got. And again, NASDAQ really has not seen much of the darkness below the 50 level in the RSI. And you can see we're on this huge, very steep slope and trajectory to the upside on NASDAQ. You can see we broke it the week of the 22nd of September, and now we're attempting to regain it. Let's zoom in on the daily, and I'll show you what I mean. There's the upslope and trend line. If we step out the green line, you can see just how steep this is. We broke it, and we formed this channel right in this area here to the downside, and we closed right on that channel line here. So this really hasn't been resolved. We're hanging on by a thread, essentially, with all indices. But if you honor the charts, it says we're still in an uptrend until the lines and charts and key price levels tells us we're not. If I zoom in on the 120-minute chart, let's really zoom in on this so you can see this downsloping channel a lot better. There it is right there. You can see this downsloping channel that we started back on the 18th of September on this 2-hour chart. And you can see us following it very closely. Every time we get to the upper boundary of this channel, sellers step in. Okay? Every time we get down on the lower, buyers tend to step in. And we had what I thought was going to be a capitulation day there, and sometimes it could be and this has happened across all indices, the Dow, the S&P, and also the Russell, where we had a lot of volume and just a big move down and all of a sudden a big move back. So buyers quickly pushed it inside the channel, and now we're sitting here on this chart. So we could be in one of these kind of crazy ass markets where it's 2 steps down, 1 step back up. So you have these false sense of rallies, but it gets to a point and we got sellers selling the rally rather than buyers buying the dip. I mean, we had buyers buying down there, but sellers certainly are putting a lot of downward pressure on all the markets. So we're not out of the woods yet, even though the Dow was up over 200 points today. I think it was up 208 points. So we're not out of the woods yet. And if we look at the volatility, we had a great play in volatility the past couple of days. You can see here, let's come back into the daily chart. You can see here we had these peaks. And I told our members, to take a trade to the downside. So we shorted volatility right up at this level up here because we had it right here. And I'm not going off on the left-hand side of the chart. But every time vol has gotten up, to this level, up in this area here, it hadn't stayed here very long. And the odds favor it coming down hard and quick. Well, in one day we got down to here. Now that's not to say it can't come back up in a couple of broad strokes if the markets really give it up and end up back there again. So we took half profits right at that point there. So now we're sitting on less. And if it comes back up here again, I may let it run or I may shut mine down for profits or the remaining piece for profits and then let it get back up here and then take another trade to the downside. Okay? That's where we're looking at with volatility right now. And then the other one that's very interesting to me is bonds. I find bonds a fascinating story this year because it's just confounded so many people. You can see here bonds has just really confounded people. You can see this upsloping channel right here, that little blue line that I've got, which is pretty much, represents the entire year of 2014. If I were to box in the year 2014 right there, this is where we sit. We actually started the year on the lows with bonds, and now we're sitting right there. I mean, that performance is better than all the indices on a trajectory basis. I mean, it is just outperformed, and yet we're hitting all-time highs. What gives? Well, I've gone through the explanation a number of times with our members. Even though and remember, when bonds go up, interest rates go down. And now most people have been sucker punched into this because they've been saying, well, the Feds are going to start raising interest rates, so bonds have to start going down and interest rates have to start going up. Well, yeah, they do. But the problem is it's a global economy. And the problem is you've got European government securities that have less interest rate offerings than the U.S. Treasuries do. So if you've got $1 billion or $5 billion or $100 billion, where do you put it? In an Italian bond drawing less than 1% or U.S. Treasuries drawing about 2.3%? You're going to put them in U.S. Treasuries. So money is coming in from other sources, other countries, Europe especially, and investing in our bonds because it's safer actually, and they get a higher interest rate. It's a no-brain trade. So we got all this money coming in. So the Feds can be very thankful, I guess in kind of a strange Machiavellian sort of way, that they're putting a lot of downward pressure on bonds. I'm sorry, they're putting upward pressure on the bond price, but downward pressure on interest rates, which is really good for the U.S. debt, because we're carrying about 1.8 trillion, in bonds on the balance sheet, and for every 1% interest rate increase that we have in the marketplace, that adds about 180 billion, right, to expenses, to government expenses, right? Just 1%. It's insane. So they're in kind of a conundrum, and they got to figure this stuff out. But anyway, that's what's coming up right here. The other one that I've had our members in, we've been playing and having a good old time in, is the dollar. The dollar just took off today. I mean, look at this trade. My goodness. When we got the unemployment numbers out and they fell below 6%, and we got strong numbers across the board, money was flowing into the U.S. currency and out of all the others. That's about the only currency that finished in the green today. Every other currency was down bad. It just wasn't pretty. But we're strong the dollar. We're long the dollar. Now, realistically, this trajectory cannot keep up. So this was a good day, but it cannot keep up this pace. We're going to get a pullback. For those that are not in the dollar, wait for a pullback, probably a retest of either that level or this level right there, and then you can play it long. All right, everybody, this is a quick update for this weekend. Just as a reminder, in about another month or two, be on the lookout. We're going to be running a really great new educational webinar series. I'll tell you about it more as we approach the date. Otherwise, members, I will see you this Sunday night for our Sunday night edition for what's coming up for this next week. If you're not a member, I'd check us out on the website. I think you'll find a lot there for you. Have a good one, everybody. Have a great weekend. Bye now.